Hi, morning everyone. This is Tara. In this week's webinar, we will be providing updates from our recent meeting with Banyan Tree Holdings, as well as updates on the S-REITs and land transport sectors. We will also share on our Singapore monthly for July and a review of the Phillip 20 portfolio for June. We held a corporate lunch event last week with the management of Banyan Tree Holdings, and here are some of our takeaways. De Hong is not here today, so I'll be presenting on his behalf. As you may recall, Banyan Tree Holdings had tied up with Vanke as well as Accor Hotels in separate strategic partnerships. There was an option for them to take up an additional 5% of Banyan Tree Holdings shares each. However, this lapsed in April. So since then, there had not been any official announcement by the group. But since we got some updates from the management for Vanke, this was mainly due to the stricter capital controls and regulations in China with regards to overseas investments in the hotel industry. For Accor, the reasons were less clear. However, both companies currently still hold 5% of Banyan Tree Holdings shares each, which were purchased at 60 cents per share. While no management contracts have officially been announced on the back of these partnerships, we note that the group does not typically announce such signings, even for previous contracts, perhaps due to contractual confidentiality reasons. However, we are confident that the group is still advancing well. So excluding the Accor Vanke deals, the group is slated to open 28 new hotels in the next 3 years, mostly under management contracts. Banyan Tree Holdings continues to enjoy other benefits from the Accor Vanke partnership, such as lower commissions paid to the online travel agencies. So just to give you a sense of the quantum of amount that they usually pay, it's usually in the mid-20s, about 20+% for the smaller operators, but they get to enjoy paying lower commissions in the low teens, 12 to 50% for big operators such as Accor. We are particularly impressed by the fact that more than half of the Chinese buyers for the group's development properties in 1Q18 were from Vanke's network of contacts, and these buyers made up approximately 60% of property sales in 1Q18. So I think these two are tangible evidence of Banyan Tree's effective ability to leverage on both Accor's and Vanke's networks. Going forward, Thailand, which is the largest contributor by geography to the group's revenue, remains strong. The strong growth in tourism is still expected in the country, with international tourist arrivals growing 13% year-on-year in the first 5 months. Outlook-wise, Asia, particularly China, remains the most important group of tourists for the groups, exactly for the reasons mentioned earlier. And also for context, this group made up more than 44% of total room revenue for FY17. The management also highlighted Korea as a fast-growing target market. We currently have an accumulated call on Banyan Tree Holdings with a target price of 73 cents. Last close was 53 cents. We expect strong RevPAR growth in Thailand to be sustainable, and growth catalysts to also come from the management contracts from the Accor Vanke partnerships. Next, on the S-REITs, we have just released our inaugural Singapore REITs monthly report this morning for the month of July. Let's take a look at the year-to-date performance for the S-REITs. So year-to-date, the FTSE S-REIT index has been down 3.3% in comparison to the STS decline of 2.7%, with the biggest correction in February. Current S-REIT dividend yield spread over the 10-year SGS is at 294 basis points, which is still lying below the -1 SD range. The post-GFC historical average has been at 361 basis points. Bloomberg consensus forecasts for the 10-year SGS yield at the end of this year and next year are at 2.62% and 2.88% respectively. Assuming all things equal, a continued rise in the 10-year SGS yield will be a headwind for S-REITs. On the short end of things, as you can see on the right, the 3-month SOR is currently at 1.59%. This is near 10-year highs, and this has accounted for the second Fed rate hike of the year in mid-June. Market expectations are for 2 more rate hikes by the end of this year. So where is the relevance for REITs here? it will be flow down to the financing costs. However, higher near-term financing costs for the REITs are largely mitigated, as 31 out of 40 of all S-REITs have at least 70% of their debt hedged on fixed interest rates. Zooming into an overview of the subsectors, save for retail, there has been tapering supply across all subsectors. Retail sales inched up just 2.3% year-on-year in May. Supermarkets and F&B posted declines, and department stores and fashion posted gains. The gains for fashion was mostly on the back of the shift in the Hari Raya calendar. Competition for the consumer dollar remains intense. We are starting to see big international players such as Taobao and Amazon gain market share here, and also bringing in the online to offline concept. For example, Taobao held its very first home pop-up store in Singapore in June. This was a 3-day pop-up sale in Suntec City, and they offered free local shipping for all the items on display there. And Amazon would also be launching their very first Prime Day here in Singapore. This is their biggest annual event on July 16, which is today. For commercial, 2 major transactions happened in the past month. These were Capital Land Commercial Trust, CCTs, divestment of 20 Anson, and Fraser's Commercial Trust, divestment of 55 Market Street. CCT demonstrated effective capital recycling through its higher entry yield than from its acquisition of Asia Square Tower 2. Co-working expansion continues as we witness WeWork's opening of their flagship office just 6 months after establishing their maiden presence here. For the rest of this year, the only upcoming Grade A office supply is 18 Robinson. For industrial, against the backdrop of the M&A activity happening between ESR REIT and Viva Industrial Trust, ARA Asset Management acquired remaining shares in the REIT and property manager of Cash Logistics Trust from CWT, thus ending the sponsor REIT relationship between CW and Cash. This will also mean the ROFR pipeline would be ended. So right on this note, Mapletree Logistics Trust acquired 5 ramp-up logistics properties in Singapore from CWT for about 778 million. These properties were formerly in the ROFR portfolio from CWT to Cash. For hospitality, we have seen an uptick of 5% year-on-year in visitor arrivals in April. RevPAR rose 6% year-on-year to $192 in April. We anticipate higher tourist arrivals, although on a more gradual basis, following the Trump-Kim summit in June, which had heightened global awareness of Singapore as a tourist destination. Overall, we remain neutral on the S-REIT sector. We like the commercial, industrial, and hospitality subsectors due to tapering supply. This is especially in context of the surge in supply in the prior 2 to 3 years. However, we are cautious on the retail subsector as retail sales and shopper footfall both remain lackluster under pressure from e-commerce competition. So I think on the top of investors' mind would be what would happen to REITs in this rising interest rates environment. So for investors with concerns on rising interest rates, do look for REITs with low gearing, high interest coverage, long weighted average debt to maturity, and a high proportion of debt on fixed interest rates, such as CRCT, FLT, Ascender REIT, and Keppel KBS US REIT. For CRCT, we have an accumulate call with a target price of $1.66. For Ascender REIT, we have an accumulate call with a target price of $2.91. The other 2 REITs are currently not under our coverage. Other REITs we have an accumulate call on are CCT, Keppel DC REIT, Cash Logistics Trust, and the Bicon Dasin Retail Trust, which is a business trust covered under SGX StockFX scheme. Here we have our S-REIT universe, which is a compilation of the latest data from all the S-REITs. With reference to what I mentioned earlier about the criteria on identifying a quality REIT in this rising interest rates environment, you may focus on the 3 colored columns: gearing. For as you would know, the REITs are subjected to the 45% leverage limit, so the lower be better. the second column to focus on would be the approximate percentage of debt on fixed rate. So the higher the better. And lastly, the percentage of debt expiring in this year as well as next year. So the lower or more spaced out, the better. Thank you. So I'll be passing out to Richard to talk about the land transport sector.
Thank you, Tara. This is Richard speaking. So last week we published a report on land transport. Basically, it's giving an update based on the data from LTA for the taxi and taxi driver license. So for our view on land transport sector, we remain overweight. Positive industry restructuring resulting from the exit of Uber, and the worst is over for the taxi industry. You will notice that ComfortDelGro has already started buying new taxis. They've already bought 200, and then they've called for a tender for another 500 more. So for ComfortDelGro, we maintain accumulate an unchanged target price of 269. Last close was 235 on Friday. So what's the news? First, Toyota announced that they are going to invest 1 billion in Grab. However, there's not much direct impact on the ride-hailing aspect for Grab, as the investment will go towards improving their other capabilities such as GrabFood and GrabPay. So once again, no direct impact on its ride-hailing business for now. And then the next table shows the data that's been published by the LTA. So you can see, let's start the first line for taxi. Taxi population has declined almost 19% year on year. And year to date is 8.2%, but month from month it's been flat. So for taxi population, actually it has already seen 3 consecutive quarters of year-on-year decline of about 19%. So it seems like this decline is bottoming, because the decline has already seems to be tapering already. And then for rental cars, year-on-year population is 10.7% higher. But year to date, it remains flat. And in fact, on a month-on-month basis, the rental car population has come down by just slightly 0.2%. For number of TDVL holders, year-on-year is only 2.8% lower. Year to date, it remains unchanged. And month-on-month also is a flat. The positive momentum for number of TDVLs issued maintained in May. So May year-on-year, the number of licenses issued increased by almost 60%. But bear in mind that it came from a low base. And then on a 5-month basis, there was a total of 1,600 plus licenses issued, and that's 100% more than the first 5 months of last year. The other news is that the deadline for attaining the private hire car driver's vocational license has lapsed. That was the end of June, and it was reported in the news that only about 51% of the applicants had passed the test. So it will be an offense for those who have not passed the test to continue providing the service. And then the other news is that the CCCS has determined that the Grab-Uber merger is in breach of competition laws. Okay, so the positives wise, while taxi population continues to contract, but the rate of decline shows sign of bottoming. And then I've also explained this in the previous slide. Rental cars growth is tapering down and the population remains stagnant. So that means that the number of rental cars is not increasing anymore. Third point, we think that despite the findings from the CCCS, their proposed measures, we expect it to have limited impact, as actually, if you think about it, the bottleneck is actually the number of private hire drivers that have passed the PDVL. Only 51% have passed, and that is the bottleneck that we're referring to, where there's going to be a lack of drivers to drive the cars. The other one, as I mentioned before already, the momentum for TDVL issued has been maintained. For negatives wise, Grab will still likely maintain its dominant position in the ride-hailing space. They already enjoy a strong network effect from first mover advantage, and so we currently have an overweight on the sector, but just for discussion, what will make us turn negative on the sector? So the things that we will look out for is the resurgence of the cheap fares and higher driver incentives, and also regulatory action that undermines the recovery in the taxi industry. Just a recap, so we're maintaining overweight on the sector and maintaining accumulate on ComfortDelGro. This table is showing the proposed directions from the CCCS following the conclusion of their review of the merger. So there are actually 4 proposed directions, and then on the right is our view on these directions. So for the first two directions is basically removing any exclusive arrangements between the drivers and the app, and the drivers and who they rent the car from, whether is it taxi or a rental car. And so we think that removing these exclusive arrangements is fair. For the third proposed direction, that is asking Grab to continue with the low prices or continue the prices before the merger. So of course, that's not quite fair to them, as everyone knows the prices was artificial at that time, and also driver incentives are not sustainable. Lastly, the fourth proposed direction is that Uber is not allowed to sell Lion City rentals to Grab, but we think that that's irrelevant because regardless of who they sell the fleet to, the exclusive arrangements are supposed to be removed anyway. So this does not affect drivers who still continue to rent from Lion City regardless of who owns Lion City rental. Yeah, this chart just shows the population for taxi and rental cars. So as I mentioned earlier just now, the growth rate for rental cars already is tapering down. You can see that, and so that's why the population here has stagnated here already. For taxi wise, population is still coming down, but the year-on-year growth seems to be bottoming already at about 19% year-on-year. This has already been like this at 19% for 3 consecutive quarters already. As for the taxi driver vocational license issued, so we maintain somewhere around just slightly over 300. If you look back historically, the usual number that's issued is about 400 plus minus 100, so it ranges between 300 and 500 licenses issued per month, and so we're still in that range, so it looks fair now. As for number of license holders, it's remained unchanged year to date. And this is a pie chart showing the distribution of all the applicants for the PDVL. So there's two parts of the PDL. First, you must attend a course, and then you have to pass the test. So 51% have passed the test. Of course, implicitly, that means that they attended the course as well. 40% did not complete the course, and then another 7% completed the course, took the test but failed it, and 2% completed the course but did not take the test. Yeah, so now we'll move on to Paul, who will talk about our Singapore monthly.
Yeah, thanks, Richard. I'll move on to our Singapore monthly report. We just call it tail risk to the to base case. Okay, basically, the two tail risks that we're referring to, firstly, is basically we think that the trade war will get worse. I mean, our assumption all along was Trump was just supposed to be only posturing, but obviously this is not so. We're expecting another 400 billion worth of tariffs on tariffs to be imposed also on 400 billion worth of Chinese imports. Then you have another 200 billion of auto imports that will be that is also there's a threat of tariffs about 25%. Then in the background you also have NAFTA negotiations, which is after the midterm elections. We do not think we think that this trade war will escalate because Trump will be emboldened. As you can see, the US jobs market is very strong. And furthermore, you have fiscal stimulus support for him to push further on this trade war. And also, if you look at his approval ratings, we'll show you a chart later, it's actually still very firm. And the other trigger point for this trade war would be a weaker RMB. So this could be another flashpoint that they may use to actually push further for more restrictions on Chinese imports. Just on a snapshot of the situation, the global economic situation is still expanding. But as you know, the uncertainty will rise as these trade tensions escalate. In the near term, the market may perk up a bit because of we are coming into the earnings season. And there is obviously going to be a lag in terms of the impact of these tariffs and even the implementation, which we will elaborate later. Okay, locally, again, the other tail risk locally was, of course, the property sector. We were obviously surprised because of the cooling measures. The previous two cycles was about 17 quarters of upcycle before the authorities came in to impose any measures. Whereas for this cycle was about four quarters of upcycle. Sorry, not imposed. Sorry, the usual upcycle is about 17 quarters, but the current cycle was only 4 quarters, and they started to impose cooling measures. The other reason was the HDB prices were actually moving sideways, so we thought there was no real necessity for them to impose these measures. I guess we are not as clairvoyant as them. Okay, in terms of banks, we still like banks. Due to, as mentioned many times before, the margins are improving, volume and wealth management. The second quarter results will be coming out early August, so that should help trigger some catalyst for the share prices, as we expect the results to be good. REITs has already been mentioned, and in terms of coal, although the price performance hasn't been as good, but we are still positive on the coal sector. I think the fundamentals remain strong. As you can see, power consumption, as you know, one of the largest consumers of thermal coal is power. Power consumption or electricity consumption in China is up year to date, up 9.5%. This is the fastest pace in 7 years. At the same time, you have domestic production in China, which is very weak, but down about 1%. No change in our individual stock recommendations. Only thing that we cut our STI target. As you know, our STI target is based on, we take all the price targets from our in-house analysts, and also stocks that we do not cover, STI stocks we do not cover, we will use the consensus target prices. So actually we lowered it down to about 3,007, this is the lower end of the target prices. I think we are very concerned of the tariff headwinds, and as a result, we are cutting down on our target price for the STI. Okay, if you move on to the next slide, as you all know, everything is about the trade war right now. And we think the situation will escalate. As you can see, this is basically a chart on Donald Trump's approval rating. Obviously, from the time he was elected to now, it's obviously deteriorated, but this is a normal for most presidents. And as you can see, at this point in time, it's almost similar to where Obama's rating was in his first term in office. So the ratings are actually, and they're obviously off their lows, as you can see. So his approval ratings actually reasonably firm despite all the rhetoric that we hear. And the second thing is other indicators. If you look at consumer confidence and even small business optimism index in the US, these are near 17 and 45-year highs. So domestically, the economy is still very strong and sentiment is still very robust. And also, if you look at if on the fourth point, if trade deficit is really his target, or if that's the measure he's looking at, then we are in for a bit of trouble because it's unlikely to be resolved, the US trade deficit. The only way this trade deficit will narrow is if you have a major aggregate demand collapse in the US, and that's probably the worst case scenario. Okay, we move on to the next slide. This is the second time we flashed this slide. We will update it as this trade war or trade tensions escalate. I guess the latest points will be at the bottom. As you all know, there are going to be two public hearings. The first public hearing is on the 19th, 20th July on the 200 billion of auto and auto parts. Actually, it's more than that. Auto is actually 200 billion. If you add in the auto parts, it's another 150, 160 billion worth. So almost 300 plus billion. So there's a public hearing, and then most likely he will impose another 25% tariffs on these parts. Worst hit will be the European makers. The autos usually comes from Canada, Mexico, and Europe. China is impact very little on this. Then, of course, round 5, as you can see, the next one is the upcoming 200 billion of Chinese imports. There's again another public hearing on the August 20th and 23rd, and then he will implement it on the September 18th. So these are the two big ones, the auto parts and also the Chinese 200 billion. And he again mentioned before that he will impose another 200 billion if China retaliates, which is likely that China retaliates. So you're up for another another 200 billion, totaling up to 400 billion. Basically, all Chinese imports tariffs will be imposed. As you can see, there's about 500 billion of US imports, about 500 billion. So 400 billion plus another 50 up here. So about 450 billion on paper will face tariffs. Okay, US imports about 2.4 trillion worth of goods a year. Okay, in terms of the impact, I mean, there are all kinds of studies you want to use, but anyway, there's another IMF study that says that if US impose 10% tariffs, there will be a general impact of about 1% on global GDP. Again, these are all estimates because all this depends on how the currency moves and how each country retaliates to it. As mentioned earlier, there's also the NAFTA negotiations. Okay, I'll move on to the next slide. Just a very quick snapshot on the global economy. I think the global economy is still stable. It's stable in 2018. It's not accelerating very fast or decelerating. As you can see from the line the blue line. This is basically the aggregation of all the global PMIs. As you can see that it performed better in the second quarter. First quarter, you can see that the global PMI dropped at least just at 1.2%. In the first quarter. The main reason is, as you can see, the light green line, which is the Euro area, had suffered a major decline in PMIs. And that's the reason. But in the second quarter, as you can see, the PMIs or the manufacturing survey are actually quite stable in the second quarter. If you look at Asian exports, Korean, Taiwan, and Singapore, the Asian exports are actually stable. They're not accelerating. In the first quarter, they grew about 9.8%, in second quarter, 8.9%. So they're more or less quite reasonably stable. And as mentioned earlier, the US jobs numbers were actually quite robust. And with the wage growth only creeping up slowly, that's why we had a bit of a run on the US markets, because going back to the so-called Goldilocks scenario. Okay, but and then we move on just on a quick point on China. It's not stellar, but it's still stable. If you look one barometer, at least for China, fixed asset investments, it's up about 6% year to date May, whereas the prior year was 8.6. So it's not stellar, but it's still stable and growing. This is our model term portfolio. June, we did not perform well in June, although we kind of outperformed the STI. it was a worst performance for us in June for the year this far. We saw sell down across all stocks except dairy farm and micromechanics. Year to date, the ones that has hurt us the most has been Asian Pay TV due to the disappointing results, and also Geo Energy as the production did not come up to expectations. But we are still positive on Geo because of we expect production to recover, and also in the background you have healthy coal prices. Okay, I'll move on now to Jeremy on his Phillip 20.
Hi, good morning, everyone. Jeremy speaking here. So I'll just run through the Phillip 20 portfolio, basically what happened in the month of June, what went up and what went down. But before I dive into the Phillip 20 portfolio, let's just take a look at the STI performance for the month of June. So as you can see over here on the screen, this basically is showing the STI on the daily time frame chart, and probably just highlight what happened in the month of June. So for June, what we saw was the STI was down 4.65%. Basically, again, the negative sentiment that we are seeing here is mainly caused by two factors. The trade war tension between US and China, as well as the recent dollar strength that we've seen at least since the start of May. So you can see the steep decline here since the start of May was mainly caused by the dollar strengthening side of things, whereby we saw the dollar index actually strengthening for somewhere around 5 to 6% for the past 3 months. So two factors here kind of overhanging the market here, at least for the STI. And just to highlight again, probably this highlighted area over here, the sharp sell-off that we saw at least 2 Fridays ago was mainly caused by the new cooling measures that was being imposed on the property market. What we saw was the STI actually got hammered down on the particular day itself 2 Fridays ago, and we saw this particular big gap down on the STI, kind of dragging the STI down by about 2% or so on the day itself, on 2 Fridays ago. And again, the implication here is we saw the STI actually tagging a key support level at 3,200 points, which basically is a key psychological round number. And that level was particularly interesting is because for the whole of 2017, it has been a level that has been keeping the long-term uptrend intact for the STI. So what I mean by that is you can see prior to, on the left side of the chart, highlighted a few regions here. Every single point there shows you the point where the 3,200 point psychological round number actually keeping a floor on the STI. And you can see the most recent retest of the 3,200 point support level actually kickstarted a new wave of bullishness. So for instance, you can see this first leg up, at least based off the rejection of the 3,200 psychological round number, what we saw was actually an 8% move to the upside for this particular wave. And if we were to tag the wave up all the way to January this year, we are seeing a move of about 11%. So obviously with the most recent sell-off starting since May, especially with the cooling measure sell-off that we saw 2 Fridays ago, you can see even though we actually closed below the 3,200 psychological round number on that day itself, subsequently the last week's price action, we have kind of get a confirmation that the buyers are still respecting that level pretty strongly. And more importantly is how price actually closed back above the 3,200 point psychological round number for the whole of last week, kind of justifying that the bearish break 2 Fridays ago was kind of a forced bearish breakout, which is a positive sign. And if we were to dig deeper, what we see is the price action actually shows us that the buyers have actually break and closed above this immediate downtrend line, which is another kind of signal that the bulls are kind of regaining strength here. And coupling that with the relative strength index study. So the bottom panel here shows you the relative strength index. What we saw was the strong selling momentum starting since May have actually dragged the RSI into oversold condition. Oversold meaning the RSI being below 30. It happened somewhere around in June, and you can see for this whole period here, the RSI was actually in oversold kind of territory and actually hit an extreme low of around 23. And with last week's bullish price action, what happened was we actually saw the RSI moving back above the 30 oversold region, kind of confirming that we are seeing a mean reversion playing out here. And all in, whenever we see an oversold RSI mean reversion happening, historically, at least based on our study, what we expect is at least a 5 to 6% recovery when this kind of a signal plays out. So all in summary, at least in the near-term outlook for the STI, with this bullish rejection of this 3,200 psychological round number, as well as the bullish breakout above this immediate downtrend line, and the mean reversion of the oversold RSI, we are expecting the STI to actually kind of form a near-term bottom at this 3,200 point support area. And for the STI to kind of move back into its long-term uptrend in the meantime. And in terms of target-wise, we are expecting the STI to retarget this key previous support level to become the next resistance at 3,341 points. You can see 3 critical points here back in November as well as February and April. Expect this to be the next target for the STI, and once we breach through that level, STI should be targeting this resistance back here somewhere around 3,462. So all in near-term outlook-wise for the STI, we are expecting this 3,200 points to hold, and for the bulls to come back into town for move to the upside. And hence, for the Phillip 20 portfolio, for those that haven't been following, Phillip 20 portfolio basically is a portfolio that is constructed based off technical analysis, based off our model. And for the month of June, with that volatility in the market, we managed to enter 7 new trades, mainly China Sunsin, Jaffa, DBS, Hoppa, Singtel, City Development, and Wing Tai. But obviously, with the negative sentiment that we saw, at least a 4.65% sell-off in the month of June for the STI, quite a few trades here are actually also being closed out and triggered their stop loss in the month of June, especially the property side of things due to the cooling measures. And the following slide shows you the realized P&L. So in total, 7 trades were closed out, triggered as stop losses due to the negative sentiment. And we also decided to close out our position in Jaffa due to a bearish signal that was kind of being triggered somewhere in late June. So in terms of closed trade that triggered their stop losses, we had Memtech, DBS, Wing Tai, Chip Eng Seng, Singtel, Franken, and Jardine CNT, all hitting their relative stop loss. And Jaffa, we decided to take profit at 62 cents. But all in terms of the holistic portfolio performance, we did pretty decent, at least for the month of June. The Phillip 20 portfolio was up about 1.8% as compared to the STI of negative 4.65%. And the main reason for the outperformance here for the month of June is, at least from the portfolio perspective, BreadTalk was the kind of stock that is holding the performance up for the month of June, which I'll show you in a while. But all in the performance, we are up 1.8% as compared to negative 4.65% for the STI. And on the total return perspective, we created this portfolio since last year, May. And total return as of last June was 2.28% for the Phillip 20 portfolio. And as compared to the STI, total return since May was right now at 2.88%. And watch list wise for the Phillip 20 portfolio, we are watching strong uptrending counters. So here is a list of stocks that are at least still holding on to its long-term uptrend. And in terms of bullish outlook wise, still seems pretty strong. We'll continue to watch this space in terms of adding new counters into the Phillip 20 portfolio when we see some opportunities to actually enter back into the market when the bullish price action actually surface. And last but not least, here's the current snapshot of our Phillip 20 portfolio as of last month, 29 June. And again, to highlight again, the reason why the Phillip 20 portfolio kind of outperformed the market in the month of June was because of BreadTalk. So since its entry in 2nd November, it's currently up about 44%. And it's the main reason why the Phillip 20 portfolio kind of outperformed the market in June. And here's the snapshot. And yeah, with that, we've come to the end of our webinar today. We'll pause right now for any questions. Thank you.
This is Richard speaking. There's a question on our view on data center REIT. So we cover Capital DC REIT. Our current rating for that is accumulate and target price is 151. For data center wise, demand drivers remain unchanged so far. So nothing much to update for that.
Hi, there's also the question on our view on healthcare REITs. So there are only 2 healthcare REITs, First REIT and Parkway Life REIT, for only of which we cover, the former of which we cover. So for First REIT, our call is maintain neutral as of the last quarter results, with a target price of $1.31. So potential catalysts for us would be an improvement of a sponsor's credit worthiness, while downside risks include a similar tax regulation change, which had happened in Indonesia on the properties that would affect First REIT. So First REIT's results would be released this week, and we'll probably have an update next week.
There's a question on the global economy chart, where is the China line in your global economy? Yeah, I didn't put the line on China because otherwise it'd be just too congested. You can assume the China line is probably inside here, which is the part of the emerging markets. And as you know, China is probably the largest component of emerging markets. Yeah, thank you for the question. Yeah, there's a question. Hi, you're positive on coal. Today background was sold down. Care to comment? Okay, the back coal news is as per from their announcement. I think there have been some media in Indonesia regarding some corruption case. And most important, they said that their RIA 1 project is still in progress. I will need to double check with management to understand what's the latest development before I can comment further. But I'm just taking up from their announcement this morning that the sell down was due to some press article on some corruption case by some of their consultants. Yeah, thank you.
Hi, there are questions on Netlink Trust. However, we currently don't cover this stock, so I'm unable to comment. They are releasing results on the 6th of August, so you can probably look for updates then. As there are no other questions, we will conclude our webinar for today. If you have any residual, sorry, just give me a minute.
Yeah, sorry, just a quick one. There's one question on the global PMI, the slide. How is it? It comes from market. Market does a survey of 12,000 purchasing managers from all over the world to come up with this global index. Yeah, thanks.
Hi, thanks. If you have any residual questions, please go to our Stocks BNB page. So you can post the questions to any of us. Thank you.